This episode is brought to you by Indeed. Stop waiting around for the perfect candidate. Instead, use Indeed sponsored jobs to find the right people with the right skills fast. It's a simple way to make sure your listing is the first candidates see. According to Indeed data, sponsored jobs have 4 times more applicants than non-sponsored jobs. So go build your dream team today with Indeed. Get a $75 sponsored job credit at Indeed.com/podcast. Terms and conditions apply.
K-pop Demon Hunters Haja Boys Breakfast Meal and Huntrix Meal have just dropped at McDonald's. They're calling this a battle for the fans. What do you say to that, Rumi?
It's not a battle. So glad the Saja Boys could take breakfast and give our meal the rest of the day.
It is an honor to share.
No, it's our honor.
It is our larger honor.
No, really. Stop.
You can really feel the respect in this battle. Pick a meal to pick a side.
Ba-da-ba-ba-ba.
At participating McDonald's while supplies last.
Who's with me? All right, let's do this, people!
Live from Joe's mom's basement, it's the Stacking Benjamin Show. I'm Joe's mom's neighbor, Doug, and how would you like to be a stock market maestro? Today, we're talking to 2 researchers who've studied the best and brightest for over a decade, and today we'll report on their findings. It's Flynn Levy and Lee Freeman-Shor. Yeah, and believe it or not, with all those names, it's still just 2 people. In our headline segment, more and more financial advisors and pros are using AI. Is there a potential downside we haven't yet imagined? We'll pose this question to OG. But we don't do that before I pose to you my awesome trivia question. I'll bet you get today's right so you can brag to all your friends. And now, 2 guys who brag to their friends that they get to help you with your money habits. It's Joe and O-G.
Well, hey there, stackers. Welcome back to the Stacking Benjamin Show. We're super happy you're here. Sit down and relax. You found us. Grab whatever you're going to take notes with because we're about to help you do better with your stock portfolio. I'm excited. We haven't talked stocks in a long time, OG, and with markets,
Those are going down.
The markets bump around a lot on a normal day. We always laugh and be like, oh, the market's volatile. The market's always volatile, but it might be a little bit volatile lately. So good time to talk about analyzing your portfolio. How are you doing today, man?
I'm a little upset. We are recording this on opening day of March Madness, which is ridiculous timing and planning on our parts. So I might be a skosh distracted.
Well, let me tell you what's going to be really fun today. If you've ever had a coach analyze your swing, if you've played a sport, or more importantly, if
I tried to have Doug analyze my skiing one time, all he did was laugh.
Well, that's his analysis.
Don't suck that much, and I won't laugh.
Yeah. Or even more importantly, if somebody's given you've had a great coach that's helped mentor you, help you work. Man, our guest today, Flynn Levy and Lee Freeman-Shor. Yes, only 2 people, Doug. They are incredible, have a great background, and they're going to coach you on better investing habits today.
They're hogging all the names. They should give some back.
I think they're also hogging all the bio because listen to this. Flynn Levy, she's the founder and CEO of Essentia Analytics, and they're a fintech firm that what they do, they work with investment managers and people who are capital allocators, right, for these big pension funds. They help them look at how they make decisions through analytics to know where their biases are, mistakes that they often make, how to stop making those mistakes, to see where the opportunities are, just 100% data driven. Before that, she spent 10 years as a fund manager. She ran over $1 billion of pension funds for Deutsche Asset Management. Later, she was CIO of Avocet Capital Management in London. Claire has done it, but she's paired with, because we get all the best coaches here in the basement, Lee Freeman-Shor, 16 years in investment management, one of the world's top fund managers. He was co-head of equity research at Old Mutual Global. He has written several books on making better investing decisions. So we're bringing it, stackers. We're bringing the best and brightest to help you invest better. So We've got Claire and Lee coming up next. But before them, we have a couple sponsors who help us keep on keeping on, and we can bring great people to you like Claire and Lee for free. We're going to hear from them. And then Claire, Flynn, Levy, and Lee Freeman-Shor join us to help you with your portfolio. Spring cleaning's made its way to my closet. This time of year always makes me rethink exactly what's in my closet. Really want to keep fewer things, but I also want to keep better ones. I want to feel confident, and to feel confident, looking the part's a big piece of that. So I want pieces that are well made and that are easy to wear all the time. And that's why I keep coming back to Quince. The fabrics feel elevated. The fits are thoughtful. Pricing actually makes sense. As I'm swapping out and I'm cutting, the few additions I'm making all come from Quince. Quince makes high-quality, everyday essentials using premium materials like 100% European linen. They're insanely soft, flow-knit activewear fabric. Their men's linen pants and shirts are lightweight, they're breathable, they're comfortable. Basically, the perfect layer for spring. The pants strike the right balance between laid back and refined. If you saw the video of me on stage at Retire Meet, those pants are from Quince. It was really cool. I came off stage and Christine Benz from Morningstar getting ready to go on behind me and said, "Love your pants." Not generally. I absolutely love them. I think they make me look put together without trying too hard. And they're flow-knit activewear, moisture wicking, anti-odor, soft enough that you'll actually want to wear it all day. The best part is their prices. This is important, stackers. They are 50 to 60% less than similar brands. How? Quince works directly with ethical factories, cuts out the middlemen, so you're paying for quality, not brand markup. Everything's designed to last and make getting dressed easy, which is another thing I think we all want. I love those pants that I wore on stage. It's the cashmere sweater that every time I wear it, Cheryl goes, "That is my favorite sweater on you." It looks great, feels great, and I don't have to have 50 things in my closet. So, like I am, refresh your wardrobe with Quince. Go to quince.com/SB for free shipping and 365-day returns. Now available in Canada, too. Go to QUINCE.com/SB for free shipping and 365-day returns. Quince.com/SB. You may not know that when we started Stacking Benjamins, it was a blog. And even then, just the startup cost, I remember thinking, is this the right thing? And what if I write things and nobody comes, right? Well, luckily, that didn't end up happening. But starting something new isn't just hard. It's terrifying. There's so much work. You're not sure whether it's going to work out. You're not sure if anybody's going to read it. And then we change it to a podcast. Is anybody actually going to listen, right? What if nobody wants all the stuff that we have? Well, had I used Shopify, it would have been even easier, because with their expertise, their helpful tools, and their easy-to-use platform, that's something that would have made Stacking Benjamins more effective much, much more quickly. Shopify is the commerce platform behind millions of businesses around the world and 10% of all e-commerce in the U.S. Names you've heard of like Heinz and Mattel, Shopify, Gymshark, Aviator Nation, Allbirds, also all Shopify. Get started with your own design studio with hundreds of ready-to-use templates. Shopify helps you build a beautiful online store that matches your brand style. And best yet, Shopify is your commerce expert with world-class expertise in everything from managing inventory to international shipping to processing returns and beyond. And did I mention that iconic purple Shop Pay button? It's used by millions of businesses around the world. It's why Shopify has the best converting checkout on the planet. It also helps boost conversions, meaning less carts going abandoned and more sales for you. So you're stacking Benjamins much more quickly. Time to turn those what ifs into with Shopify today. Sign up for your $1 per month trial today at shopify.com/SB. Go to shopify.com/SB. That's shopify.com/SB. And I'm super happy we have these two, I'll call them maestros at research, here with us. Lee and Claire join us on My Dad's Shortwave Radio. Thanks for coming on. I appreciate it.
Yeah. Thanks for having us.
We've had Jack Schwager on a couple times talking about stock market wizards, these people that, are traders, they're heavy duty. And the general thing Jack has shared with our stackers before, Claire and Lee, is that these people are remarkable. You don't want to be them. Stick with index funds. What's the difference between a wizard and a maestro, the work that you two really focus on? And I guess, Lee, I'm assuming you may have coined the term stock market maestro.
Together we coined the term. We were trying to think of a name of what to call our experts, wizards and maestros. In my mind, and in Claire's mind, I think the difference is wizards to us are people that are more short-term orientated, more trading. The 12 stock market maestros we feature in the book, which are phenomenal investors, award-winning investors, are just that. They're investors. They tend to take a longer-term view. They're investing in public equities, names you'll have heard of, the big cap, but we got small cap guys in there. But that's the key distinction. They take a longer term view. They're investors, not traders, and they're phenomenal executors of ideas. And that's why we called them maestros. And Claire can probably chat about, Claire, maybe what we looked at to determine how good they are at executing their ideas.
Yeah, sure. I mean, I think of both wizards and maestros are holding wands and the wizard's going zap, zap, like point and shoot direct. The maestro has like long sweeps and is, conducting a symphony, and it's a much more fluid and less, there's something more musical about that to me. But the maestros and wizards are very similar. It's, they're both good. There's nothing, that's not a question of is one better than the other. The maestros that we've interviewed, they're all public equity, long only. Well, no, some of them are hedge fund managers, but all public equity fund managers. And maestros, you get traders who trade all sorts of different things, not just public equity. But in that way, they're sort of closer to us being, any old person who maybe invests in the stock market or doesn't, but invests in mutual funds or ETFs or the like. Like they're doing the long-term investment thing is what we're all supposed to be doing. So the learnings that come from them hopefully are very applicable to people who are not fund managers, but who, have yet to make decisions with their money. We all do.
Claire, your company has a series of metrics to evaluate these people and help them to evaluate themselves, which I find fascinating, and to look at the traits that make them better investors. Is it more about process or is it more about results that makes them a maestro?
I mean, in the end, and this is how Lee and I actually met. So 10 years ago, Lee wrote a book called The Art of Execution, which was a study effectively of a bunch of different fund managers who he had allocated money to. So he and I we both used to be fund managers. And in his book, he documented what he learned from running money with these different managers. And I read this book and it really resonated for me because I had just started my company, Essentia Analytics. And having been a fund manager, what I was trying to do was create analytics that would be like sports analytics, but for investment decision making. So to make it possible to reflect in the same way an athlete reflects on their own performance. That's what I had been looking for as a fund manager.
Almost like, Claire, like where the hitches are in your swing or where you're throwing the ball the wrong way.
Exactly. People spend a lot of money on golf analysis. It's like, this is no different. This is actually your livelihood, unless you're a professional golfer. But the way that Lee was looking at things is very similar to how we're looking at things at Essentia. And that's what ultimately led to us working together. But what he found was that in the end, the success of the manager or the investor, any one of us, it's not just about getting it right all the time. Even the professional, very best fund managers typically do not get their ideas right 50% of the time. It's how they behave when they are right and how they behave when they're wrong that makes all the difference. And that applies to every one of us. But it is the sort of thing you can see in data. So in Stock Market Meisters, we vetted a long list of award-winning fund managers, 70-odd award-winning fund managers, and then got their data and analyzed it and narrowed it down to these ones because these are not all people who have a batting average over 50%. In fact, on average, they're under 50%. But what they do well is the slugging part. If people are baseball fans, in the end, it's like you can be wrong a lot as long as when you're right, you're very right. And when you're wrong, you're only a little bit wrong. So you got to get the big things right.
I remember Peter Lynch saying something like that a long time ago, that he lost far more often than he won. But when he won, he would be able to win big enough that it would make up for a bunch of losers. Lee, it fascinates me when Claire talks about your earlier works. You actually, in the intro to this project, you focus on the different types of investors that Claire is beginning to shine a light on for us. These different people, the rabbits, the assassins, the hunters, the raiders, the connoisseurs. I love these terms. Can you walk through this? Because I think we all make these mistakes. We become the wrong type of investor at precisely the wrong moment, which wrecks what could have been a great position for us to hold as an investor.
So just reiterating what Claire says, I mean, I discovered the chance of an idea making money is 49%. And these are the best investors in the world, very successful, toss of a coin as to whether an idea makes money. And yet people obsess about stock picks. What my research shows is, no. What matters is what you do when you're losing and winning. So going back to your avatars, if you like, the tribes. So if you're losing, people will typically fall into one of three tribes. They'll become a rabbit, a hunter, or an assassin. You don't want to be a rabbit. A rabbit is a losing trait. A rabbit, someone that when they're losing, they do nothing. And what's bad about that is that invariably, if you do nothing, you could hold something that goes down a lot. And if you understand just geometry of returns, if you're down 50%, you need 100% to break even. If you're down 75%, you need 300% just to break even. You don't want to dig such a big hole. So they're rabbits. And when I found rabbits in my team of professional investors, I fired them, because they're managing between $25 and $150 million for me. So you don't want to be a rabbit. You want to be an assassin or a hunter. And I'm guessing for the audience of this show, an assassin is probably the easier one to be. An assassin is someone that says, okay, I've lost somewhere between 20 to 40% in this name. I'm getting out. Like a cold-blooded killer, you just kill the position. And that ensures you're not going to lose too much and you're not going to permanently impair your capital and you can move on. The market's kind of saying either your idea sucked or your timing sucked or both. The hunter is someone that basically, when they're down 20% or more, they kind of think, well, I still believe in the idea. Nothing's broken. It's just the market. I'm going to throw a lot more money at the name. Now that, I would argue, is a lot more difficult to do because when you've lost money, throwing more money at an idea, it kind of plays with your mind thinking, what am I doing? You kind of doubling up might be a mistake. So, for a professional, it might be a bit easier to do that. So that's on the losing side. On the winning side of the ledger.
Sorry, can we, before we get to the winning side of the lecture, because I do want to talk about when we're losing, because when I began investing, my natural reaction was, this is a good idea. But timing, to your point, Lee, I might have been a little early. The position is going down, so I'm going to keep dollar cost averaging into it, right? I'm going to make my average lower so it's easier to bring it back. But then I realized, reading people like the two of you, that this might just be my ego getting in my way, and I need to be okay with the fact that I called it badly.
Yeah, I couldn't agree with you more. I think the ego is the enemy. I mean, that's the biggest enemy of all of us. I mean, it's very hard when you're in you've done a lot of research on an investment, you put your money in it, and then you see you lose, it's losing, and you it's hard to walk away, especially if you still believe in the name. And sometimes you just have to acknowledge you've got it wrong. But to your point, I mean, if you've done a lot of work and you think you're right and the market's wrong, which is, can be a bit of a dangerous way to think, then pound cost averaging would make sense. Or my guys, they didn't do, I guess the difference is, for me, they didn't do pound cost averaging. The difference between a hunter and a pound cost averager is a pound cost averager would go, I'm putting, say, $100 a month into a name. And over time, that's a great strategy, by the way, if you're going into something like index funds. Yeah, I can't fault that strategy in that way. But in individual names, what my guys would do is they'd go down 30% and then they'd double up. And they put a lot more money in. And that's a very different beast to pound cost averaging. And that, if you don't know what you're doing, that can be very dangerous and you can go to the poorhouse pretty quickly, which is why I said earlier, for an average investor, I was thinking someone like my mum and dad, it's probably better for them to adopt being as an assassin when they're losing than trying to be a hunter. Or they could do what pound cost averaging, what you suggest, isn't a bad idea if they're doing it in the traditional fashion of a little bit every month in a name, which is a bit of a different game. I mean, Claire, would you add something?
I mean, I would just say the key thing to wrap your head around is that you have a less than a 50% chance that your idea is right. So if it starts losing, to automatically want to buy more, you're assuming that this is one of the ones that you're right about. Okay, so that it's already you've got a less than 50% chance that this is one of them, but you're saying it is one of them. Okay, with a hunter, the hunter is saying, I've done the extra diligence. I've got really good reason to believe that this really is one of the 49% or the 40. Today, I see average hit rates closer to 40%. So you have to be able to work from the baseline of, wow, I know I'm going to be wrong more often than I'm right. So then it becomes about being aware when I am wrong sooner rather than later, and being aware when I really do have very high conviction that I'm right, and revisiting that every time to say, nope, this is one of the 49%. This is definitely one of the 40, in which case double up. But I think most people innately believe that they're right more than 50% of the time.
We're all above average, Claire. We're all above average.
Yeah. Yeah. Unfortunately, that's called overconfidence, and is very well documented behavioral bias. It's something we all struggle with. But if we can be very honest with ourselves and objective and forgiving, not saying, oh, I get it wrong more than 50% of the time because I'm a bad investor or I'm stupid or whatever. No, that's just you being a normal person. But knowing when you're wrong, in other parts of life, you have signals that tell you, like, hang on a second, I have a feeling I'm barking up the wrong tree here, or this is not the right person I should be with. The red flags are there. We have to learn how to recognize them when they're there, cut our losses and move on, and take it on the chin. And I think it's easier to get to that humble space when you've taken more punches, the longer your life has gone on.
I love that because, often a lot of our younger stackers, they're afraid of making the mistake when they first start. And what you're alluding to is make mistakes more often, fail forward.
Yeah.
I do have a question, though, that I'm sure some of our stackers are yelling at their device. Why is it 49%?
I mean, actually, most in the Stock Market Maestros book, the Maestros median was 49%. The long list median was 45%. So it basically just looked at every single position that these people have ever held and said, what percentage of those actually outperformed the relevant benchmark over the period?
Which means then, Claire, this is why your 40% earlier is important, because you're saying for our average stacker out there, probably would be closer to 40 or maybe even less than that.
Yeah. I mean, that's a good reason to invest in a fund if you want, to not have to wear the stress of only being right 40% of the time, because it can be stressful if you don't get used to that just as a basic fact.
Guys, I love that sidebar, but Lee, you were about to transition into the winners on the winning side, where we get it right and where we get it wrong.
Yeah. So when you find yourself winning, people will typically fall into one of two camps. They'll either become a connoisseur or a raider. And as much as I like Raiders of the Lost Ark, you don't want to be a raider. Raiders, these are people that make 10 or 20% and they bank the profit, move on. Now, when you realize your success rate is less than tossing a coin, you banking 20%, believing that you're going to rotate that profit into a better investment is a bit of a fool's errand, I'd argue. And the main finding is you want to be a connoisseur. Connoisseurs are people that, the Peter Lynch, you run your winners and you win big. You let your winners, compound out and win big. And I can tell you that the guys on my team that were successful, they all had one common factor amongst them on the winning side. 2 or 3 big winners accounted for the majority of their returns. So if you strip out those 2 or 3 big winners, their returns profile of their overall portfolio becomes very average or bad. And so you can't underestimate the importance of having 1 or 2 big winners. So if you've got a process whereby you're selling out of your winning names after making 10, 20%, and then you're holding on to your losers and ride them down 50%, you're going to go to the poorhouse pretty quick. So be a connoisseur when you're winning. That's the lesson.
The case studies on these people, on these connoisseurs, to me is so fascinating. And the things that they share, the things that you got out of them are incredible. I'd like to talk about, let's focus on one at first and then just talk about some traits that you found throughout the book. But Claire, let's start where you start, with Josh Goldberg. Who is Josh Goldberg and why did he make it into your very, very short list of maestros?
Well, Josh is a hedge fund manager based in New York, and he actually, of all of the maestros, has maybe one of the most traditional backgrounds, in the sense that he went to Wharton and he went to work for hedge funds, and he worked with all these well-known fund managers and learned his trade. But what he has developed is a strategy that is very process driven, very straightforward in that it's based on earnings surprise and on taking signals from the market. And it kind of goes back to the same point. It's like, you're going to be wrong at least 50% of the time. So you need to constantly be asking yourself, what evidence am I getting back from the market that this is one of the right ones? And for him, that's earnings announcements where, a company reports their corporate earnings and the market responds very positively. And he doesn't mean just like a little bit positively, like big gaps positively. To him, that contains information and it reinforces his conviction that he's right about that one. So it becomes, yes, I think this is one of the 49%. And then he has implemented rules around, what does it take to get into the portfolio? So you're either convinced or you're not. So you're not going to have tiny little positions for any length of time. It's either going to show you it's going somewhere or it's not. But also when things start going wrong, he's got signals worked out through analysis. And, he is a client of Essentia Analytics, although I should say only half of the maestros are people I ever had met before. The other half are totally random, but people who I was able to get the data for.
Just to focus for a moment on that note, for him, he uses your data to get better. He subscribes to your data to find out what he's good at.
Yeah, he is a continuous improver by nature. And I would say all of the maestros, that is something that they have in common. They're all humble enough to look in the data mirror, which is not, it sounds like, of course you would be, but no, looking in the mirror can be kind of mortifying sometimes. And not everybody is feeling brave enough to do that. But these guys have all gone there, had a good look, figured out what it is that they're not perfect at, and either created rules or signals to help them manage their own emotions and mitigate the biases. Or they've used what they've learned to substantiate, like, okay, here's how we hold on to our winners. So to achieve what Lee described in having a handful of really big winners, you have to hold on to them. And that's a brave thing to do a lot of the time. So it's like, you've ever heard the quote about, you don't want to be watering the weeds and cutting the flowers.
Oh, yeah. Yeah.
It is like a garden, if you think about it that way. When you plant all the seeds, every one of those seeds is a precious, this is going to be the best flower ever. And you put them in there and you water them, and then things start growing. Some of them work out way better than you thought they were going to be. Some of them, there's nothing there. It's not growing, and you just have to keep on testing the soil, watering, fertilizing, doing the things and nurturing the ones that are going somewhere and clearing out the ones that are going nowhere so you can plant something else in their place. And that's what these people are doing, both with their portfolios, but also with their investment processes.
Let's use Josh to kind of dive into some of the tactics of getting in. As you just explained, he uses this idea of earnings surprise. Does he try to predict which company has an earnings surprise beforehand, or does he do it after they've had an initial earnings surprise? Lee?
No, he always waits until there's been an earnings surprise. So not trying to be a soothsayer and forecast the future. A company was surprised on earnings, and then he and his team will dial up the research on the name.
It makes it easier then to filter, I would think, Lee. I mean, working from this whole wide range of companies to just a few every quarter that probably surprise.
Yeah. No, it helps narrow down the universe. Then he'll jump on those that have surprised and decide which ones to allocate to. And I think the key thing about Josh is, he does that. He allocates capital to them. But then it's how long do you ride it for? All the maestros have one thing in common, which is they're masters of execution, because it's how you execute the idea matters. So in his case, what does a connoisseur mean for Josh? And what you find with him, thanks to working actually with Claire, he's discovered that his sweet spot is to hold a name for about 15 months. So during that time, generally speaking, the earnings will surprise and keep surprising. But if you hold on after that, you risk kind of round-tripping the name. But during all that time, him and his team are constantly on it, looking at it, thinking whether it will go more. But he's got that flag that pops up around the 15-month mark, which is okay, usually this is where it can start fizzling out. Do we still want to be in it? And, that's some of the wisdom he's learned working with Claire over the years and feeding back and improving his game.
This way of getting in, sounds like a machine, Claire. He starts off the machine with an earnings surprise. They go into the funnel, and then, then he works it through all of his other processes that he has. To me, this kind of speaks to the idea of an investment policy statement, right? How big is an investment policy statement to these maestros, not just Josh, but all the ones you looked at, versus my gut tells me that Apple's going to be big next quarter?
Once upon a time, that is what we thought made a good trader, that they were born that way and they had a great gut. Now, it is possible that some people are better at pattern recognition than other people and that their gut is that. But all of these maestros have documented process that they follow. And it typically involves other people, not just themselves. They have teammates that they converse with when things hit certain levels or when certain things come up. Some of them have very formal, when this happens, we sell this percent. James Inglis Jones and Samantha Gleave from Lion Trust, who are also maestros profiled in here, they have what some people would call that a systematic fund. The humans in their case are making decisions, but they've literally implemented rules that say we always do this when this happens. In Josh's case, he's not applying that rule as rigidly. He's saying, okay, I get a flag at month 15. I look at that and say, all right, here's 5 other reasons that it's probably time to get out of this stock. And the fact that it's hit its 15-month birthday, we know statistically that in the past, that's tended to be the end of the road.
Yeah, I'm in the danger zone now.
Yeah, and it's just the odds start to move against you that this is one of the ones that's going to keep performing. So now you have to ask harder questions of yourself to justify hanging on to it. So he's sort of taken a slightly more human approach to applying these statistical rules. But in the end, they both use computers to work out, where is it historically that I should have made a decision? What should that decision have been? And now I might use that to always make that as a rule in the future, which is what James and Sam did. Or in Josh's case, say, okay, well, I'm going to use that as a guideline for helping me make a decision as a human.
I'm glad you focused on that, because I feel like too many stackers out there, too many just individuals hear about their buddy at work did something, or they're in this wonderful fund, and because of that, it's going to fit my portfolio, and it could be right for you and might not be right for you. And it also might not be any good for the person who's telling you about it. Who knows what process they use? I love that. All of these maestros also, Lee, have a process of getting out. And often, and you talked about this earlier, with Josh, there's this risk after 15 months that he might follow it up and then all the way back down, right? And you definitely don't want to do that. What are some of the keys to figuring out when I'm going to get out of a position that might not serve me anymore?
So for each of the maestros, the point of the case studies where we follow them in one of their investments or 2 other investments in terms of which worked and didn't work. So you can actually see what signals enabled them to sort of decide I'm getting out or not. If we stick with Josh, he will not lose more than 1% of the fund in any idea. So, once he's lost 1%, he's out. And some of them have those kind of hard rules, which is, once I've lost this much of my money, I'm out. I don't care if I like it. Still, it doesn't matter. I've lost enough money. Idea could still be good, but I've lost enough. So some have that. Others will have different signals which trigger them as to when they should be getting out. A lot of the times, if they're wrong, obviously these are professionals, they'll be getting signals from the company itself, in terms of looking at the fundamentals and things like that. That will trigger them to actually get out. And that's why you want...
This is like a new earnings report comes out or something, or more news comes out?
Yeah, it could be something like that. Yeah, where some news flow comes out about the company, or they read the quarterly report, or they have a meeting with the CEO management and something doesn't quite smell right. And they think, no, I'm getting out. So I think you'll find that quite interesting for each of the investors, that there's a myriad of soft signals, right, which could trigger you to get out in terms of, there's loads of them. So you have the soft signals from the meetings with managers, reading reports. And then you have the hard ones, which is, that's it. Some will have rules like, okay, I'm down 20%, let's review the name. And they do, that's a trigger, so it's not a stop loss. Like I think, a wizard or a trader will have stop losses, lose 5-10% out. Maestros, because they play a longer term game in public markets, investing in stocks, they're more, okay, down 20%, let me review, get the analysts together, or they start looking at the investment case again. And then they have questions they'll ask themselves, which are simple but powerful questions, such as, okay, if I didn't own this already, would I buy it today? And you've got to be honest with yourself. And that's the difficult part. Try and forget you've lost a lot of money and just say, if I was looking at this today, looking at the share price like this, everything I know, would I buy it today? And I think a lot of people, if you ask yourself that very simple question, you'll probably go, hell no. And if that's the answer, you sell. You run for the hills.
But what I would think, Lee, helps you there is if you've built a system like we talked about, you have an investment policy statement, you just apply the top of the funnel of your investment policy statement. If the answer is no, I wouldn't have bought this, it wouldn't have fit in the top of my funnel, then it makes it easier to get around your ego in that case, I would think.
Yeah, but I'm a big fan of Claire as well. I think that he's, in my first book, The Art of Execution, I always talked about the importance of having a plan of action before you put capital in a name. Because trying to decide what to do when something's lost money and you're in a hot emotional state, it makes it 10 times worse. So if you've already got a plan of action as to if things go wrong, here's the checklist of what I'm going to look at. If I see these, it's red flags. If I lose this much money, I'm going to get out. You should have all that set up before you even put a single penny in a name.
Then you have to follow it, right?
Then you have to follow it, yeah.
People will put a ton of work into their investment policy document, and now the document's in a file, and now we've never seen that again. That's the human, in the end, undermining him or herself. So that's where using technology is key, because you don't want to have to dig that thing out every time. It needs to be super handy, really easy to do. Actually, easier to do it than not do it would be even better. That's, I think, the biggest piece of the puzzle. How do you get yourself to actually follow the process? Because you have great intentions, but if you make the process too complicated, you're not going to follow it.
With all the sophistication in today's world, a couple of the maestros adopt simple tricks that even I did when I was a fund manager. One of them, Stephen Annis, he has a laminated piece of paper stuck on his desk. So he's got these key learning messages and golden rule, everything there so he can quickly flip down it and just to remind him of things that matter. And another one, John Lin, who's, arguably the greatest investor in China. And for him, he has, behind his desk, he's got, a cork board, and on there he's got pinned key rules, which, every day you can look at, just glance over his computer, look at, just to remind him of the salient things in the moment that sort of are there. So you don't have to Claire's point, dig out that policy document and remind yourself of various rules.
I have my screensaver was some of my big important things to remember when I walk in my office in the morning, like they were on the screensaver before I shook my mouse. There it was right in front of me.
Yeah, I like that.
Yeah, same thing. I do have a couple more questions before we say goodbye. One, Lee, you mentioned international maestros. Claire, did you find anything that really changed when you're looking internationally versus just looking one country specific?
I mean, every one of these maestros has a different strategy. And, there are a few that are looking at small cap stocks and a few that are looking at large. So they might have a little bit of commonality in terms of what they're looking at, but they're all looking for different things. And I think only in the case of John Lin, probably is there a very region specific thing going on. And that's really to do with the characteristics of the Chinese market being so dominated by retail investors. And so the way that prices behave it's like how they behaved decades ago in Western markets. So he's able to do a strategy that you probably wouldn't be able to do elsewhere just because of the market opportunity that exists. Lee, would you agree?
Yeah, 100%. In China, the taxi driver will buy something on Monday, sell it on Friday. Professional fund managers, he was even telling us, which is quite shocking, their bonus structures can be based on weekly and bi-weekly performance. So they're incentivized to basically lock in profits very short term and trade like crazy. So a lot of momentum investing approaches that would work maybe, in the US, for example, would be a disaster in China. And he shares these insights with the reader of the book. And I think that's an interesting case study. He's the most differentiator, I'd say, of all of them, because the Chinese market's so very different.
Yeah, I just found the case study so fascinating. And to your point, I think you said it earlier, Claire, just how different their strategy is, but their adherence to it. They would come in every day and just work the system and improve the system. And man, that resonates through everything that these men and women do. One place that our stackers are doing something different than your maestros are, which is, they're trying to put together a portfolio for their retirement. So instead of focusing just on small cap or large cap or international or whatever, where a lot of these people are focused on one market, they're focused on the broader, getting some of each. But still, diversification, it seems like, Claire, matters to these people. Like having only so much money in a certain position. Is there ever a time that you see that for somebody, it makes sense to begin selling it, even though it's a winner, just because your exposure becomes too high and the risk becomes too high?
I mean, that's actually an interesting one in that we have different approaches amongst the maestros. So there's one maestro called John Barr, who he's a small cap specialist who he knows his particular part of the tech space like especially well because he used to work in that industry.
I felt like he was that kid. You made a baseball reference earlier, Claire. He was my friend growing up who knew the back of every baseball card. He knew which farm team kids played for, like all their middle names. He knew everything. John Barr seems like that kind of person.
He definitely is that guy. He definitely is. But what he does, and we call this the lumberjack tribe, a brand new tribe, is plant seeds and then let them grow really, really big, like way bigger than a lot of the other maestros would. Some of them would say, I never let a position become more than 4% of the portfolio. Now, sometimes it's because the rules of the fund that they're running are such that they can't. But in John's case, he really takes running your winners to heart and lets them become very large. That's a way of making money.
What does he think about the danger in that? Because he clearly is a brilliant guy. He knows that his Achilles heel gets bigger as that tree gets bigger and bigger and bigger, and he doesn't chop it down. How does he handle the risk of that?
That's a good question. I think now he is not an Essentia client, so I don't actually know the detail of the way that he does it. But I think that he's watching drawdowns, and he's definitely, when he has a big winner that then comes back a good way, he's reevaluating on the basis that does this story still hold? Has it got that much more juice left in it? Because it's so easy to fall prey to the endowment effect, which is, the bias whereby we value something highly because it's ours. And you can fall in love with a stock. You can fall in love with pretty much anything, the longer you have it, it grows on you. And maybe it's made him a lot of money. It grows on you that much more. But the risk is you don't see the cracks start to form, and then suddenly it's over.
It's like Lee said earlier that you put it back at the top of the funnel. Would I buy this today is kind of what you're saying that he'd do. But it's funny, Claire, that you bring that up because you're really showing him as different. For most of them, then it really does matter when something, because if you're shining a light on John where it doesn't, I think what you're also saying is for the majority, though, it does matter.
You mean how big the position is?
Yeah, how big the percentage of the fund is dominated by one or two different investments? Or are you not saying that?
It depends on what type of vehicle they're running, because different vehicles will have different rules attached to them. But for most of them, and Lee, feel free to disagree, but I think for most of them, they do have a strict rule about not getting bigger than a certain size. And that might be 5%, that might be 4%. It's somewhere in that region.
Yeah, I mean, I'd just jump in and say, so if you look at someone like James Hambry, for example, UK hedge fund manager in the UK is very famous. He's a guy that made over 100 million in 2016 from positioning his portfolio from benefiting from the UK leaving the European Union. If you look at him, we share an example in there of something like plus 500, where he's been in it since 2013. He's made over 6,000%. And this is a name that's had 50, 60, 70% drawdowns along the way. But the way he controls risk and is being able to win so big is he will adjust the position size. So at various points, you'll see that name being as low as 1% and then as high as 9%. But the way he tries to size it, so he plays a sizing game, is he moves incrementally. So he's aware that psychologically, emotionally, we want to do the wrong thing at the wrong times. So he'll increase and decrease his positions in 0.5% steps. So if he's 9% and he thinks, oh, maybe this has gone up a lot in the short term, or maybe I should take some chips off the table, he'll go from 9% to 8.5%. Then he'll take it to 8%, then 7.5%. So he moves like that, slowly and incrementally. If you have someone like James English Jones and Samantha, the UK pair, but they invest in European markets, they'll have a process whereby it's more systematic, but if something's working during the year, they let it run. They're looking at the quarterlies every quarter, and as long as it's working, it's fine. And then every year they have the hard reset. Would we buy this today? And at that point, if they would still buy it today, but it's run and it's gone up to, say, it's grown, they start at around 3% position. But if it's grown to about 6 or 7%, what they'll do is they'll take it back down to, say, 5%. They don't take it down to 3%, though, like a starting, which would start, because they recognize that often winners keep winning. So to hack it right back would be a mistake, and sell out would be a definitive mistake. So, that's what you'll tend to see. A lot of them don't let positions get too. Greg Badia, who's another one, US, great investor in the US, he'll tend to invest at about 2% position, and he'll let it run up to about 6% position. If you think about it, to go from 2 to 6% of your fund, it's got to have done very well. And when it gets about then he'll start trimming it back. But all of them will trim back. And one last thing I'd say about John Barr is he's made 100x in Nova since he's been in it, 100x. But if you look at what he does, he'll invest in it at outset very small, so 0.1 or 0.2%, very small. When he invests, he calls it a hidden compounder. So he realizes in early, no one's focused on the name, and it could go wrong, right? But if it goes wrong and it's only 10 or 20 basis points, it doesn't matter. And that's why we call him a lumberjack, because if it goes down 70, 80%, he can kill the position like an assassin would, but it hasn't cost him a lot, which is different to a rabbit. It'll be 4% position and drive it down that much. But then as it works, it starts to growing. He'll let it grow to a 2 to 5% position. And at the point when it's a 2 to a 5% position, that they've become what he'll call a quality compounder. So what was hidden is now there on public view. People know about it, and it's delivering. And Claire's point earlier is, as long as it keeps delivering, he'll keep riding it. But again, he's not going to let it get too much bigger than that. You won't see anyone holding more than 10% in a name.
I found that fascinating, though, because he can plant a lot of seeds when he's planting them that small.
Yeah.
Earlier I said, you don't want to be a rabbit, right? And that's because rabbits, in my world, when I was investing, my guys invest in just 10 ideas. Very focused funds. If one of those ideas goes wrong and it's a 10% position and you ride it down 90%, you've cost yourself 9% at a fund level. It's a huge hit. But for someone like John Barr, if he's got a 0.2% position, or let's say a 0.1% position, it goes down 90%, it's hit nothing. It's done nothing. So it doesn't matter. So hence we had to come up with a new name for him, which we called the lumberjack. And just to explain the lumberjack, his family background is from Chicago, and his family is a lumberjack family. And he ordinarily would have gone in the family business, but as he describes, he wasn't really cut out for it. He shares a story about him driving the truck with all the trees on the back, all the tree trunks on the back, and he went around a corner and all the loads spilled over the road. And, and it took him all day to get those logs back on the back of the truck. And he says, I really wasn't cut out for the family business. So Claire and I are thinking, what sort of captures that, and the fact he invests with small position sizes at outset, sort of that forestry kind of horticultural kind of background. And planting seeds seemed to be, and Claire came up with lumberjack, which I thought was great.
I absolutely love case studies. I learned so much more through case studies. So I was super happy when I heard that the two of you had created this marvelous project. It's called Stock Market Maestros, the winning habits, strategies, and mindsets of the world's best investors. And it's available everywhere, correct?
Correct. Yeah.
Awesome. Claire, Lee, thank you so much for shining a light on this for our stackers that don't get to look really at what the pros do. And it's so enlightening and I think so helpful what you did today. Thank you so much.
Thank you for having us.
This is Erin from Colorado Springs, and when I'm not teaching 3 boys how to patch hockey stick holes in drywall, I'm stacking Benjamins.
Hey there, stackers. I'm Joe's mom's neighbor, Doug, and it was on today's date back in 1983 that Michael Jackson did the impossible. He performed a move called the moonwalk during the taping of a TV special for Motown's 25th anniversary, creating a craze that lit up the nation and the world. When I think of the important things in my life, I'd probably put learning the moonwalk as a solid number 1, ahead of being born and marginally ahead of that one time I scored a free dessert at the Sizzler after Todd, the manager, screwed up my order. That was so awesome. In fact, I'd rank Michael Jackson's moonwalk as one of the greatest things in the past 70 years, ahead of the birth of Taylor Swift and the actual first moonwalk. Here's the question, though. While Michael banked some serious Benjamins doing his moonwalk, all the other moonwalkers did was create history. Who was the first person to actually walk on the moon? I'll be back right after I go see if I can moonwalk upstairs to the refrigerator. Never tried it on a stairway. Maybe that's the next big craze.
Dell PCs with Intel Inside are built for the moments you plan and the ones you don't. They're for those all-night study sessions, the moment you're working from a cafe and realize every outlet's taken, the times you're deep in your flow and can't be interrupted by an auto update. That's why Dell builds tech that adapts to you. Built with long-lasting batteries so you're not scrambling for an outlet, and built-in intelligence that makes updates around your schedule, not in the middle of it. Find technology built for the way you work at Dell.com/Dell PCs. Built for you.
You're listening to this podcast, so I know you've got a curious mind. Here's a helpful fact you may not know yet. Drivers who switch and save with Progressive save over $900 on average. Pop over to Progressive.com, answer some questions, and you'll get a quick quote with discounts that are easy to come by. In fact, 99% of their auto customers earn at least one discount. Visit Progressive.com and see if you can enjoy a little cash back. Progressive Casualty Insurance Company and Affiliates. National average 12-month savings of $946 by new customers surveyed who saved with Progressive between June 2024 and May 2025. Potential savings will vary.
Unlike other AI, Slackbot lives in Slack. It understands you, your team, and your work, so you can ask it for help with anything.
Can I ask it to summarize client feedback?
Yes.
Can I ask it to find time for a meeting?
Absolutely.
Can I ask it to turn our meeting notes into a launch plan?
Sure.
Can I ask it to call me the boss?
Actually, you can.
The balls.
See how Slackbot can turn you into
the balls
at slack.com/meet-slackbot.
Hey there, stackers. I'm Moonwalker and guy who just found a loose step on the stairs the hard way, Joe's mom's neighbor, Doug. The joys of moonwalking. I love the idea of the backwards walk. In fact, I was doing it going down the street and I almost ran into the postman. Seriously, I never saw him coming, because I was walking backward. Anywho, today's question was this: who was the first person to walk on the actual moon? Well, the answer is nobody, because we all know that stuff was fake, right? But, if you want to go with NASA's official story, it was some guy allegedly named Neil Armstrong. That's one small step for trivia, but one giant leap for your bragging rights with your friends and colleagues. You're welcome. And now, back to Joe and OG.
Doug, before we recorded, you brought up something great. How old are you if you automatically just go Neil Armstrong?
People of a certain generation, you couldn't even finish that question before they would answer Neil Armstrong.
I was telling Paula Pant earlier in the day about this trivia question, and I got it half out. She goes, Neil Armstrong, 1969.
Oh, wow.
Paula.
For Paula.
I know.
All right. So we now know if she needs a point on a Friday trivia contest, this is the question we gotta put in there. Just give her a soft toss point.
Yeah, and weirdly, we're gonna change the Friday. Paula, you're gonna go first instead of last.
Right.
Big thanks to Claire and Lee, and just a couple points. OG, number one, their emphasis on these maestros: no gut decisions, zero gut decisions, all data driven, all the time. No, you know what? My gut says I'm just thinking this thing's going to go up.
I don't have any oil in my portfolio. It's up 30% since I last looked at it. Maybe I should buy oil.
Gut decisions, and I think it's doing real good. Not the way you make moves.
There's a very real factor of investment return that is called momentum. That's a very real thing. But it's hard to quantify on your own whether or not it's momentum that is driving it forward, or if it's just your personal observation of the market going up that's driving that forward. And that can be a very dangerous thing without having a very solid IPS in place. And this is where, this time of the investing season, whatever you want to call this chaos that's going on right now, it also happened last April, also happened in 2022, also happened during COVID. all these times are perfect examples of why it makes a bunch of sense to, when it's not chaotic, to just sit down calmly and go, this is my investment policy statement.
Yeah.
And,
and that was my next point, was the importance each of these maestros has on building a machine over just making moves. You can just continually react to the situation, or you go, wait a minute, this occurs all the time. Why wouldn't I build a machine and operate the machine that will help me make better investment decisions in the future? I love that.
Yeah, that's what an IPS does. That's what hopefully a good advisor does for you, is run the system that you guys created together. That's what a good partner does. You know, if you're working on your financial plan with a spouse or partner or whatever. Where we see people get in trouble is when they make decisions that are not based on the facts that they already had established earlier. You know, short-term volatility in the market is a given. I'm doing some research right now on investment portfolios, and the best that I can come up with is 76% of the time in 1 year returns is positive. So there's a 1 in 4 chance that this year it's negative anyway, no matter what you do. That's your basic VTI portfolio. It's 1 in 4 times it's going to be not positive. So if you go into it with that knowledge base of, you know, short-term results, short-term volatility does not mean this is how this is long-term. And frankly, your money, you shouldn't be looking at it on a daily basis anyway. If this is your investment account, this is for 10-year money.
Claire's point, having looked at all the data through her company, her point that these pros who are picking stocks, they make the right call 49% of the time. Yeah. And then you look at the broader list of pros. The broader list of pros make good picks 40% of the time. Take the Stacking Benjamins audience that isn't a pro, hasn't lined up a lot of shots, isn't doing this over and over and over with any process at all. In many cases, what's the chance you're landing a good shot, which goes back to indexing, but still also an important point, even if you're indexing, is the fact that these pros are humble enough to study their mistakes and to not make the same mistake over and over again, and to learn from the mistakes. Like the one guy, Josh Goldberg, they talked about, who's like, listen, I know I get in trouble on this stock if I do X, Y, Z, so I need to guard against that. How many times have you sat with somebody, OG, and they're like, oh, I'm going to make this change as soon as this stock comes back? You're like, what are you talking about? I remember one person that I sat with who had Ford stock, and Ford was trading at $20 a share. And they're like, well, I bought it at $30 a share. So when it gets back to 30, that's when I'll sell it. The next time we talked, Ford was trading at $8 a share.
Yeah. The systems account for that. You know, and when you don't follow the system, you're more likely to get burned. You're going to have some success too, honestly. The reality is that there's going to be an opportunity for luck involved there. Luck is not an investment plan.
And we will link to Stock Market Maestros. Just if you like case analysis of people who do stuff well, man, they brought it. Let's do a headline.
Hello, darlings. And now it's time for your favorite part of the show, our Stacking Benjamins headlines.
Our headline today comes to us from financialplanning.com, written by Rob Burgess. I want to run this by you, OG, because as I was reading this, I was thinking about potential downsides. Financial Planning is a website that financial planners, financial advisors read, people in the industry. And the headline was how vibe coding is filling the white spaces in advisor tech stacks. Rob writes, he's only been using it for about a week, but Tim Witham said vibe coding, building apps by intuitively prompting AI. So he doesn't know any of the code. He's just writing, I want you to create for me XYZ and blah, 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 blah. And then it makes it, right? Without knowing it. That's what vibe coding is for people that don't know that term. This guy, Tim, says it's already dramatically changed his practice. In the past few weeks,
in a whole week, it dramatically changed it. Wow, that's pretty impressive.
Week. Yes, literally. He's been using it for about a week. In the past few days, Witham, the founder of Balanced Life Planning in Villa Hills, Kentucky, said he's begun using Anthropic's new Claude model, Opus 4.6. The software is more than paid for itself. He said it allows him to give prompts and receives code that he can use to build tools or modify a website without the in-depth knowledge required to write the code himself. I'm paying $100 a month for the AI now, and it's already generated thousands in added value, he said. As a solo advisor, this is game-changing. And I thought about this. I'm glad you call it Spidey sense went up when you heard he's been using it for a week, because that was the first thing that caught me. But the second thing that caught me is that he's using AI that's been built by somebody else, that somebody else owns. And while it certainly for all of us can make things go better, faster, stronger, give us more opportunities to find out where we can make a difference and where we can't, I just wonder, in the world of financial advising, there could be somebody on the other end of this, even though might not be today. The people behind Claude might be altruistic and well-meaning today, but Claude gets sold to some other conglomerate 10 years ago. And they're like, hey, you know what? We got all this data from these financial planners and what they're using this stuff for. I think security-wise, I wonder if we might be stepping in it by not knowing who's mining the stuff that we're using AI for.
Well, a couple of things. I think this matters what level of subscription you have in terms of what the tools are. I'll use some other tool that more people are familiar with, like Dropbox, for example, right? So ShareFile, Dropbox, these are online filing systems that many people use. And all of these tools now have undergone intense scrutiny and security procedures to say, hey, we meet these levels of security. And I'm too dumb to know what they all mean, but I know that we have to have a certain level to, we use Schwab as a custodian, for example. Schwab says your stuff needs to be this way from a tech standpoint in order for us to, work with you. You have to have this level of insurance and so on and so forth.
Well, and I guess my question is, do you think that Tim, the guy in this piece, has looked at Claude that way and has said, hey, you know what? I'm paying $100 a month. Am I looking at who's behind this data? And I
would hope so. That's a fundamental obligation, I think. I still think that you are wanting to be safe with client data, no matter the tool, whenever possible. You don't want to email stuff. I mean, this goes back to like
basic
operational security 101,
sure,
right? Just don't email tax documents, that sort of thing. But we do individually, right? Like I'm sure, Joe, I mean, I sent you your K1 through Slack. We have this agreement that we think this is secure enough, for our use. I think advisors owe another level of what's the word I'm looking for, Doug? Another level of scrutiny. How's that? A higher level of scrutiny to make sure that when they're using any tool, whether it's a financial planning tool that we've all accepted as safe, or a custodian, or an email provider, or a digital document solution, or something new like AI, we as advisors owe it to our clients to make sure that we've done our due diligence on that, to make sure that it's as secure as we can make it. And there are different levels where they explicitly say in their contracts, if you pay us this, we provide this level of security. If you don't pay us this, then we're not going to.
Because I do know that's a danger with some of the free off-the-shelf stuff like Copilot, the Meta thing, the Google Gemini. If you're using the free version, they are clearly open that they are mining your stuff.
I was talking to a guy. So I'm doing this bike race and I went to a professional bike fitter. And it turns out that the guy is a exercise science guy, professor at a big school. And we were talking about AI and that sort of thing. And he said that the simplest way to look at AI is it's just a language model of prediction. He's like, if you looked at the temperature today, and we were talking about the weather and the temperature in Dallas, and I said, boy, Joe, it sure is what outside? What would you say would go in the blank?
Warm,
hot. The simplest form, what AI is doing is it's going, you're typing this in, it's going, we think we know what the next, boy, it sure is hot out. Like it already knows that you're doing that.
Well, based on, and how did I even say warm? It's because we're recording this at a certain time of day, at a certain month, it's a certain thing, and AI is doing the same thing. It's taking all of that data and going, okay, I'm going to predict the next thing is X.
The interesting thing, we've talked a little bit about this offline. My team sent me a funny meme about AI and all corporate executives spoon feeding. And it wasn't even spoon feeding. It was like, the meme was like somebody pouring a bucket of water into a stuffed animal, like drink all this AI Kool-Aid. And we are very heavy into looking at all of this for opportunities for us. I wouldn't say that it radically changed I've been using it for 2 full weeks, so it definitely is radically. No, we've been using it for longer.
At least 11 days.
You're a vet.
At least 11 days has radically changed. I think a couple of things. One, it is changing so fast, and the tools and the companies that are existing, and the quality of it's getting better every single day, but it is still just a tool. We are using it for research. We're using it for interesting deliverables of like, how do I make this look pretty? I'm too dumb to know how to make PowerPoint look cool, with cool graphs and backgrounds and that sort of thing. And you can feed that into Claude and say, here's our brand guidelines. Here's the colors we like to use. Here's me doing the presentation. Can you make this into a PowerPoint slide that looks neat? But I will have one little story that should give everybody pause if they're just hell-bent on diving headfirst into it and just going, sweet, I freed up all the time. Well, 2 stories. Number one, I read an article that said even the most adaptive AI, the companies that are using it the most in terms of AI, still have found 0 productivity gains. There is no productivity benefit yet in AI, and maybe there never will be. And now, is that because people are able to do more and they just take time off and they're not actually adding productivity? I don't know.
Which would be great.
Which could be, yeah, if that's the goal.
It could be quality of life.
The number 2 thing, and this is the dangerous piece with it, is AI is very supportive, right? It's like your mom who just like, you can do it, buddy. Of course you can. Yeah, you're doing great.
It's like I talked about the other day, where if new employees had that same approach,
yeah,
where they came in every day just like, I don't know anything, but man, I love you.
Yeah.
And I love working here. Like, those would be my favorite.
Yeah.
Like, people, if they train people to be like that in college,
yeah,
that would go so far.
Well, there's a story about, and this is actually an advisor story, who built a tool using AI and was very excited to show this off, right? And was just like, build this thing, cool. Now I'm going to use this in my client presentations, and was like using this thing. And it was this very interactive tool. And unfortunately, he didn't fact check it first.
Oh no.
Of course, an astute client notices and goes, wait, how does that number get to 3 million? And it's like, oh, it's just a slider here. And we just look at your portfolio. It's like, no, I understand the mechanics of, I'm challenging your math. And of course, you can imagine the sheer terror on this advisor's face when he realizes that he did not actually check the math on this before he started launching this into client presentations, only to find out that the math was off by a factor of 12. It had somehow, somewhere in there, did a multiplier of 12 because it just decided that was a good thing to do.
What's that old Bob Ufer line, Doug? Just a bit outside.
Yeah, tried the corner and missed.
Yeah.
Ball 4, ball 8, ball 12.
Wow.
So AI is super helpful. I guess what I'm saying is it's super helpful.
Sure.
If you already know what the hell you're talking about. I mean, I'm sure you guys have used it for health. I got this sore. What is it? It's probably nothing. Turns out it's something. Or it's something and it turns out it's nothing. This has been going on since Google started. So be careful.
I was helping a friend who had just gotten an inheritance fill out the beneficial IRA forms. Last year, there was a bunch of changes, and I just went to check and see if the rules around beneficial IRA had changed. And I look it up in a restaurant on my laptop, and AI gives me the wrong answer. And to your point, OG, you have to know enough about the topic. And I was telling my friend this, you have to know enough about the topic to know that it's wrong. And I knew the answer it was giving me, was based on just picking some of the words. It was based on IRA rules. It was going, rule changed from 70 to 71, 72. It depends on how old you are. I'm like, it doesn't depend at all on how old you are. What are you talking about?
What?
Yeah.
It's still not even as good as Google from a Q&A standpoint.
Yeah.
So be careful with that.
Yeah. I think it is interesting. And I think it's a good conversation to have with your advisor too, about how they're using AI and what's going on. And if you're Tim's client and he's like, yeah, I've been using it for a week and it's changed my world. And then financial planning, frankly, if financialplanning.com calls and I've been using it for a week, I'm like, no comment. I don't want to be in this interview.
or say, I've tried it out for a week. I'm really interested to learn more.
Yeah. Yes, exactly. Yeah. Wow, it's changed my world. All right. Very short back porch today. We are going to tonight have a movie screening. It's only 7 minutes long. It's not War and Peace. It is called Retirement Plan. It was up for an Oscar. Sadly, spoiler, if you didn't see it, it lost. But the fact that it made it as an animated, how often is there an animated short about personal finance? Number one. And then number two, combining retirement and animation in a 7-minute short movie that's very well done. I believe the New Yorkers behind it, just fantastic.
Remember in school how excited you were when the TV got rolled in at the beginning of class on the cart and you could tell she was going to show some YouTube movie or something? Like, that's how excited Joe is about this.
It's going to be great. It is such a good movie. And I know that for those of you that have seen it, you already know it's a great movie. I can't wait to show it. But then we're going to have about a 45-minute discussion with our friends, Tom and Don from Talking Real Money, but also they're the creators of the Retire Meet Conference. So these guys are going to help us deep dive a little bit on the themes that come up in this movie. So it'll be Doug and I, you and your popcorn, bring your popcorn, and Tom and Don from Talking Real Money. Tonight, 8 p.m. Eastern, 5 p.m., as Doug likes to say, specific. Hope you can join us. StackingBenjamins.com/movie gets you there, or just navigate over to our Stacking Benjamins YouTube page. Man, big thanks again to Claire and Lee for hanging out with us and teaching us about stocks. So important. And before we start wrapping this up, I know on Monday we talked about your cash and inefficiencies with cash. Today we talked about inefficiencies in your portfolio. If you would like to see where you stand and evaluate where you are now and what opportunities you have to be better, head to OG's Team's Scorecard. It's stackingbenjamins.com/scorecard. And when you're looking at your cash, you're looking at your investments, where do you stand? They will give you a score and you can take that rating and make better decisions, much like we did today with Claire and Lee. stackingbenjamins.com/scorecard. All right, that's going to do it. We'll see you on Friday, where Paul Merriman's going to join us talking about stocks. The Paul Merriman.
800-pound gorilla in the space, and we got him.
Doug, you've got it from here, man. What should we have learned today?
Well, Joe, take some advice from Claire, Flynn, Levy, and Lee Freeman-Shor. You can invest better by sticking with a plan. Maybe not by picking better stocks, but by understanding that pros don't try to time markets. They work from an investment policy statement, and they don't cut and run based on emotions. Second, while AI is great, remember that you have zero knowledge who's on the other side harvesting everything you're feeding it. Protect your credit and your identity, and use AI as the helper it can be. Just be sure you're going into it with eyes wide open. But the big lesson? Don't even try to ask Joe's mom to moon dance. She'll turn that into a reason to teach you to do the Carlton. The Carlton, you ask? Look it up, man. It is so addictive. Thanks to Claire, Flynn, Levy, and Lee Freeman-Shor for joining us today. You'll find their new book, Stock Market Maestros, wherever books are sold. Want to help the show? We'll also include links in our show notes at stackingbenjamins.com. And if you use it, Amazon will pay us $1 million for every book you order. That's just a little finder's fee so that I can use like an actual microphone that really works for these episodes.
Oh, boy.
This show is the property of SB Podcast, LLC, copyright 2026, and is created by Joe Saul-Sehy. You'll find out about our awesome team at stackingbenjamins.com, along with the show notes and how you can find us on YouTube and all the usual social media spots. Come say hello. And oh yeah, before I go, not only should you not take advice from these nerds, don't take advice from people you don't know. This show is for entertainment purposes only. Before making any financial decisions, speak with a real financial advisor. I'm Joe's mom's neighbor, Doug, and we'll see you next time back here at the Stacking Benjamin Show.